So what is risk management? Well, risk management firstly intends to show you how to size your individual trades. In other words, how to find the correct lot size to make sure that you're never risking more than what you want to in terms of percentage. So what I recommend is 0.5% per trade. We'll go through and actually show you how to do that. How to right size your trade in your trading portfolio. So in other words, you've got to remember you want to have a certain amount of risk per day. So if you've got trades that are open, you must look at that before you actually enter any new trade, and you have to understand how to then find the correct lot size for that portfolio of trades that you've got open. You also need to learn how to determine whether a potential trade idea is attractive enough. What we look at there is the risk to reward. Managing risk properly is a skill that every trader can and must learn in order to have that success. So let's go through why it's important. Well, it's important because even Ferraris have airbags. In other words, no matter how good your strategy is, if you don't have that protection, it only takes one accident in terms of when we're talking about Ferraris, or one bad trade to wipe your account out entirely. Risk and money management, you have to be in it to win it. But risk and money management also ensures that you will stay in it. In other words, without it, you could run the risk of just blowing up and wasting your capital away. What does good risk management do for you? Well, it stops you over trading. In other words, you know your limits for the day, you know your limits for each trade. So in other words, you don't just continue to just trade and trade and trade. You live to fight another day. Not trading too large relative to your capital, very, very important to maintain that capital. Not taking on too many trades simultaneously, therefore it allows you to sort of manage those trades successfully. Also, it means that you can be a lot more picky with your trades. If you had no risk management in place, you could just literally just keep pressing buttons without a care in the world, and just and what it does is it means that you've got no control of those trades, and it creates massive amounts of stress. So by having good risk management, it stops that entirely. Not letting any one single trade hurt you so bad that you just can't bounce back. You see, that's where a lot of people go wrong. They don't have a lot of that sort of fighting spirit or character to bounce back from a big loss. And you don't want to put yourself in that position to test yourself. If you start it from the beginning and you have the right accountability, very, very important. What we do here for our traders, whether you're doing one of our online programs or whether you're here in the office, is we give you accountability. You must always complete your trade journal and send it to us. We review it. We look at your accounts regularly to make sure that you're within your risk control, so that therefore you're not going to go and hurt yourself. You see, like if you actually want to be one of the traders on the fund, or have an opportunity to sort of actually be assessed by myself, okay, the head trader, then one of the things that we insist that you do is you keep good records, you stick to good risk management, and that is checked on a regular basis. And so that reporting gives you that accountability, so that therefore you can stick to these rules. Without it, unfortunately, most people don't. Okay, and it's really, really important. And if you're interested in being on that program, you can apply. Okay, it's a very intense 3-month program. We do offer even more intense programs which cover the same material, but in a much quicker way of attaining the information. You can do the same thing in like a week course or a 2-week course to add to what you're learning here. Okay, but just this alone should give you a real good guide into how to trade successfully. It also finally gives you the confidence that you have firepower to stay in the game. In other words, no one trade is going to wipe your account out. So what is money management? Well, money management is making sure that only an appropriate amount of money is at risk on any single one trade. And that's what we're talking about when we help traders size their trades. Okay, We don't want trading to become a gambling obsession. You can go to the bookies, you can go to Las Vegas for that and have a great time. What we're looking to do is size your risk based on your trading capital balance. In other words, your trading capital balance should be the amount of money that you've put at risk that you're actually accepting you could lose. We're not saying you want to lose or you're happy to lose, none of those things, but if you lost it, it wouldn't change your life. That's why it's very, very important that you have capital that you don't need to pay your rent, for example. Okay, because then there's too much pressure on that capital. You want to have capital that you can say, it's spare money, let me see what I can do with it. That's the right amount. Okay, I would suggest no more than 25% of your net worth. Okay, so if you've got 100 grand in the bank, don't have a bigger than 25 grand account. Because if you lost 25 grand, of course, it's not going to be a comfortable situation for you. You're not going to enjoy that moment, but you've still got 75 in the bank. If you've got 10 grand, risk 2.5. If you've got 5, and so forth, right? If you've got 5, risk 1,250. Just keep it small enough so that it doesn't affect your life. So here's a rule of thumb. Risk no more than 0.5% to 1% of your trading capital on any given one trade. In other words, as an example, if you had £2,000 in your account, you shouldn't risk more than £10 to £20 on any single trade. I generally recommend 0.5%. If your account is very, very small, you may need to go to 1%. Okay, and I would normally say 2% a day maximum risk. But again, if you're going to risk 1% per trade because your account is, say, less than £5,000, again, you could possibly increase that to 4% a day. If you've got anything more than £5,000, I would stick with 0.5% per trade, at least at the beginning. I'm trading a large size account and I never go more than 0.5% per trade. Part of my style and strategy is to scale into a position whilst taking risk off. So why use money management? Well, because you never want any single trade to end your career as a trader. At 1% risk, you will need this to be over 100 consecutive losing trades before you wipe an account out. So that's 100 consecutive losing trades. If you can find a strategy that loses 100 times consecutively, you've got a great strategy, because all you need to do is just do the opposite of that strategy. Okay, it's very, very unlikely. And now imagine at 0.5% risk, you would need to have over 200 consecutive losing trades before wiping your account. Again, even less likely. Okay, so that just allows you that breathing space that you need to trade without that pressure continually to make money. Okay, without that pressure that if you got it wrong, you're going to lose money that you can't afford. 0.5% or 1% of any account is not going to really affect you psychologically. Okay, and that's only the case if you actually don't need the money and you've put that capital up knowing that anything can happen and you can lose that money. Okay, that's very, very important to stress, guys. Okay, so let's look at stop loss versus target next. So what is a stop loss? Well, a stop loss is an automatic order that will exit you from the market at a loss. It doesn't necessarily have to be a loss, because sometimes we can trail our stop up and lock in profit, but what it's doing there is protecting you and limiting the amount that you can lose, and that's where risk management actually comes into it. So for example, before we mentioned that on a £2,000 account you may only want to risk £10 at 0.5%. So where you would put your stop is to actually reflect that amount that you can lose. The way we'd normally do it is you find the correct technical stop loss level, and then we calculate how much you can then bet, or what lot size you can put on your trading account, so that you never lose more than the specified amount. What is a target or limit? Well, target or limit is there similar to stop loss, but actually it's there to help you take a profit. So when the market does move in your direction and reaches the area where you thought it was going to get to, it's important to then take that money and profit from it. So that's why we would put a limit in. The risk to reward ratio is something that is very largely spoken about, and sometimes incorrect information about it is there. What this basically means is it's the ratio of what we are willing to lose versus the amount that we're willing to profit. A lot of textbooks, a lot of courses, a lot of education out there always specifies that you should have a reward to risk of say 3 to 1. In other words, you should be looking to make 3 times more than what you're risking. And that all sounds great in principle. However, the market doesn't work like that. And sometimes, what happens is that people take that literally and say, well, look, I'm going to risk £10 and I'm going to make £30. But what if the market is not offering £30 for that £10 risk? What if the correct technical level was only offering you £10? Well, if that's the highest probability setup and you're going for more, the chances are you'll end up with a losing trade. So what we recommend is don't take anything less than 1 to 1, at least at the beginning. Just to be kind of transparent, I'm willing to take anything that gives me a 0.8 to 1 in terms of reward versus risk. In other words, I'm willing to take £80 reward for £100 risk. The reason I'm willing to do that, guys, is because I've been doing this for long enough to know the probability of success of my trade setups. In other words, if you knew that one of your trade setups was winning, say 80% or 90% of the time, and your reward to risk was only 0.8 to 1, if you did the maths, you'd still find that it absolutely is worthwhile taking those trades, which is why I would be willing to do it. But as a new trader, I would say to you, don't take anything less than 1 to 1. In other words, if then you have a better than 50% success rate, then you'll be making money. So what we're going to do is we're going to look at some basic risk to reward examples, okay, following our C/D trading strategy. C/D is based on a Fibonacci setup that we have, okay. The idea here is we want to use mini lots to show you the risk in terms of pips and monetary value, the reward in terms of pips and monetary value, and then finally the risk to reward. So I'm going to go through some charts and show you how this works. So the C/D is based on a strategy that we have built here at LTG, and it's utilizing the Fibonacci strategy. And what we're looking to do is to trade what we call the Fibonacci extension from C/D. We will be covering this in the strategy section and going through how this works, but wanted to show you how this actually works in terms of the risk to reward. So if you have a look down here, you've got the entry. If you have a look here, this is the entry where we're looking to trade. Here's our C, this is our D target, and we would put our stop below these lows and enter here on a breakout, nice bullish candle, and the market moves up to our target. We were willing to risk 121 pips. Okay, this is the difference between the entry and the stop. And we that was our pip target. Our reward was 121 pips, which is £58.47. We were willing to risk 50 pips, which is, like I said, the difference between entry and stop, and the difference between the entry and the target is 121 pips. So in other words, would you be willing to risk £24 to make £58 on this trade? Well, there's a couple of things. One, we know it's a high probability trade setup, that it's going to reach here our target once you understand the rules of the game, which we haven't covered with you yet. And the other thing is the risk reward is better than 1 to 1, so it's at least 1 to 1, so therefore it was a good setup to take. Next, we have another setup, the entry, again C/D. Here's our stop, okay, below this low here, nice swing low, we buy it, and we're risking 43 pips, in other words £20.78 to make £46.39 or 96 pips, and the risk to reward is 2.23. In other words, we're making more than double what we're risking. So if you did £46.39 divided by 20.78, that would give you 223, or you could do 96 divided by 43. In other words, we're making more than double than what we're risking. Okay, and you can see this was our D target right there, and you can see it got there and bounced down, okay, perfectly. And all of these Fibonacci levels, by the way, are automatically drawn from an indicator that we have. Next, we've got 59 pip risk for 122 pips, and again a risk reward of 2.07. So again, look at this nice counter trend line break. We look to buy it here. Target again the D. Look at this. This is our target, and look how it gets there and bounces perfectly. Okay, this is a very, very accurate system. Okay, and we're going to go through it a little bit more detail in the strategy section, so make sure you take notes during that time. So again, another successful trade. Very, very simple trade. Break of a counter trend line, nice bullish candle, breaches our D target, and we're exiting, and we get again more than double what we're risking there, making 122 pips, risking only 59. Next, we have a trade strategy that again, it's another C to D strategy, but again this time the risk reward is a little bit less, but it meets our criteria of 1.13. In other words, it's more than 1-to-1, so we're risking 106 pips to make 120. Because you know it's a high probability setup, you've got no problem taking this trade to make 57.99, risking 51.22. And you can see again a nice counter trend line break. We enter the market, quickly runs to our target, slightly goes above our target, but eventually does pull back as well. So perfect, nice stop below these lows, and this nice supporting trend line there as well. Okay, so another great C to D strategy.